Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We'll get started here momentarily and we'll start it off with the questions that you brought. And if you have more questions, don't hesitate to chat them over, as we love to talk about questions or topics that you have. Today's topic is too rich for a Roth IRA, not with the Mega Backdoor Roth. And in today's session, we're going to discuss the fact that there are Roth IRA income limits above which someone cannot make Roth IRA contributions, but we'll reveal how high earners can bypass those caps and make large contributions to a Roth, specifically via a Mega Backdoor Roth Solo 401k. Where ultimately the funds can end up in a Roth IRA. And for 2025, one is able to contribute up to $70,000 via a Mega Backdoor Roth Solo 401k and then transfer the funds out of the Solo 401k to a Roth IRA. Again, no income limits apply to making Mega Backdoor Roth Solo 401k contributions. This is going to work for S Corp, C Corp, Solopreneurs. In other words, it doesn't matter how your self-employed business is organized and taxed. The key is that you're reporting earned self-employment income with no non-owner, non-spouse employees. That's what would allow you to set up our Solo 401k plan and make these types of contributions. So we're going to go through it step by step. At the end of the day, you'll be ready to make these larger Roth IRA contributions. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Now, let's get started, though, with a quick question, because I know you brought it. We want to make sure we get it answered, and then we'll start to go through the content that we came to bring and share. I'm here to find out about the IRS Form 945 for 2025. The only one available is the 2024. Yeah, if you look at the IRS website, that's all that they've published is the 2024 945. So one would need to just monitor the IRS website to see when they publish the 2025 version of the form, if you're looking for the 2025 version of the form. Thank you for bringing that question. We appreciate it. So, in order to be able to make Roth IRA contributions without having to worry about income limits, one would need to be eligible to set up a solo 401k. So you need to be self-employed with no non-owner, non-spouse, full-time W-2 employees. Then you need to find a provider like us that offers a solo 401k plan that allows for voluntary after-tax contributions, and then in-service transfer of those voluntary after-tax solo 401k funds to a Roth IRA. Because there are no income limits that apply to being able to make solo 401k contributions, unlike a Roth IRA, where if you make too much money, one is not eligible to make Roth IRA contributions. You also want to work with not only a provider that offers a plan that allows for those Mega Backdoor Roth contributions, but also has deep experience and provides assistance in going through the required compliance steps. So, for example, when you make voluntary after-tax solo 401k contributions, they need to be deposited into a separate voluntary after-tax account before they're transferred out of the solo 401k over to a Roth IRA. Now, while that first step of making voluntary after-tax solo 401k contributions is not reportable on your personal or business tax return, the second step of transferring funds out of the plan to a Roth IRA is reportable on a Form 1099-R. And we handle that 1099-R as part of our service for no additional charge. Now, one of the big benefits here is that the voluntary after-tax solo 401k contribution limits are much higher than the Roth IRA limits. And the overall solo 401k contribution limits are much higher. So for example, for example, for 2025, if you have the self-employment compensation to justify it, and you have a plan like ours that allows for voluntary after-tax contributions, you could contribute up to $70,000 as a voluntary after-tax solo 401k contribution, and then transfer those out of the plan to a Roth IRA. And then if you're age 50 or older, you can make additional contributions. Now, those would have to be made as either pre-tax or Roth solo 401k employee contributions, which may or may not be eligible to be transferred out of the plan. You'd have to be over age 59 and a half to be able to transfer those, say, Roth solo 401k catch-up contributions out of the plan to a Roth IRA. But at least you can make additional contributions if you have the self-employment income to justify it and you're age 50 or older. So in short, it could be even more than $70,000 in contributions. Now let's talk about the steps, the specific steps. So we're talking about somebody who's self-employed, no non-owner, non-spouse, full-time W-2 employees, has a solo 401k plan like ours that allows for after-tax contributions and then distribution of those voluntary after-tax solo 401k funds out of the plan to a Roth IRA. So that's what makes you eligible. Now you're in the game. So now how do you do it? Well, you have to have a separate account for making voluntary after-tax contributions. They need to be kept separate and segregated. And we assist with helping our customers open up accounts at the bank or brokerage of choice. For example, Fidelity, Schwab, just to name a couple. Then you make the contribution, and we assist our customers in educating them on those contribution limits. You can transfer the funds from your personal account or your business account. Either is acceptable. You would make the contribution to that separate after-tax account within the contribution limits by the contribution deadline. Then transfer the funds out of the voluntary after-tax solo 401k account to a Roth IRA. Could be a Roth IRA at the same financial institution, such as a Roth IRA at Fidelity or a Roth IRA at Schwab, or even a Roth IRA somewhere else. It could be an existing Roth IRA. It doesn't have to be a new Roth IRA. Now, while the first step of making the contribution doesn't need to be reported on your personal or business tax return, the second step of transferring those voluntary after-tax solo 401k funds to a Roth IRA, that is reportable for the year for which the transfer occurs on a Form 1099-R. And we handle that 1099-R as an optional free service for our customers. So if you go to our website, mysolo401k.net/forms, it'll take you to our forms page where we've got different forms that customers use to submit information to us. For example, there's a form after-tax solo 401k to Roth IRA, where it's a quick 1 or 2 minute form. Customers give us the information we need to be able to prepare the 1099-R, which again, if it's submitted in a timely fashion, then we'll handle that as an optional free service for our customers. Now, while there is a contribution deadline, of course, there is no deadline to transfer the funds out of the voluntary after-tax account over to the Roth IRA. Here's a good slide that shows visually how it might look. So we've got one participant who has a plan, XYZ Trust. She has pre-tax as well as after-tax funds. And then she might have pre-tax funds that she rolled over from a former employer plan, or that she rolled over from a traditional IRA. Or maybe she made pre-tax solo 401k contributions. And then in addition, she's got a second account for those voluntary after-tax solo 401k contributions. Could be 2 accounts at Fidelity, 2 accounts at Schwab, just to name a couple of examples. And then she could transfer those funds out of the voluntary after-tax solo 401k account, out of the plan to a Roth IRA. Could be a new Roth IRA, could be a pre-existing Roth IRA. For example, at the same institution, such as Fidelity or Schwab, or even a different institution. So that's how it works in a nutshell. Again, there's no income limits above which one is not able to make solo 401k contributions, which is a huge difference with Roth IRAs, where above a certain income that you might make, you might not be eligible to make Roth IRA contributions. So we appreciate the chance to discuss these topics. I see we've got more questions. Yes, this is a totally open forum. We just like to bring content as well that a lot of times is relevant to folks. But yeah, we're totally open to other questions. So it doesn't have to be on this topic. We also would invite you to use other resources. For example, we have our community with over 30,000 members, other solo 401k owners, solopreneurs, freelancers, just other interested parties like advisors, for example, that are active on that community. There's vibrant forums. We've got a library of videos and webinars. It's totally free to use. It's not just limited to existing clients. So please join. You're welcome to use it. We also have the industry's first AI, which you can use at solo401k.ai. It's totally free to use. It's a great resource, a great tool to find answers to questions quickly, other resources, etc. Now, if you are finding this to be helpful, if you could please like this video, we would really appreciate that. It'll help us get the word out to other entrepreneurs just like you. So if you like it on Instagram or YouTube or LinkedIn or X, whatever platform you're watching us on, or share it with others that might find it helpful, that would be fantastic. Thank you so much. All right. Please share anything that will help prepare. I am curious about investment opportunities for non-use balance in the solo 401k, namely when you mentioned opening a Fidelity investment account. I presume that is a retail brokerage account. So Fidelity offers their own solo 401k plan, meaning it's their document and they also hold the investments, but they will also open up brokerage accounts for third-party plans like our plan, which is going to allow for much greater features, all the advanced features like Mega Backdoor Roth, the ability to invest in alternative investments, the $1,500 tax credit, etc. So Fidelity refers to those brokerage accounts as investment-only accounts. They don't charge anything. Fidelity doesn't charge anything to open up the account. There's no maintenance fee. Schwab has their own version. E-Trade has their own version, etc. So would sending money there from my 401k restrict the use of funds from real estate? No, because Fidelity is just providing the account for a third-party plan. What you can invest in is dictated by the plan documents. So we have IRS-approved plan documents that we use to create a solo 401k for our customers' self-employed business. And then they use those documents to open up accounts at the bank or brokerage of choice, such as Fidelity. So therefore, you can invest in real estate, notwithstanding the fact that you have an account for your plan at Fidelity. So customers could even wire money out of their Fidelity account to make a real estate investment. Now, based on experience and client feedback, a lot of clients would prefer to invest in real estate via a bank account. And one can most certainly have both bank accounts and brokerage accounts for the same plan. A lot of times the reason that they want to have a bank account is because that gives them access to things like certified checks, the ability to ACH money easily in and out of the account, etc. So hopefully that sheds light on how it works. If I intend to take a maximum loan, say $50,000, so you would be able to borrow up to 50% of the balance, not to exceed 50,000. So if you roll over 100,000 or between rollover contributions and regular solo 401k contributions, you have at least 100,000, then that individual would be eligible to take a $50,000 loan. We prepare the required loan documents. So taking the $50,000 out is not going to be subject to taxes or penalties as long as it's properly documented as a loan, which we again handle those loan documentation requirements as an optional free service. Customers just have to submit an online form to give us the information we need to prepare the loan documents. And number two, as long as it's paid back according to the terms. So it's going to have to be paid back in monthly or quarterly payments. It's up to you. Equal payments of principal and interest. Those payments are spread over a 5-year term. The interest is either going to be prime plus 1% or a CD rate plus 2%. So the other $50,000 can be invested via, say, the Fidelity brokerage account. There's no minimum reserve. So what's relevant is the value at the time that you took the loan, The other $50,000 could be invested in other things, like, for example, brokerage type investments via a brokerage account that was opened up for the solo 401k. If those brokerage investments go down, that's okay. You don't have to maintain that $50,000 balance. Okay, great. Well, thank you so much for the great questions. Thank you for the great participation. Please continue to participate. Please subscribe to our channels, whether on YouTube or LinkedIn or Instagram, X, because we do hold these daily webinars where we like to bring content, but to also field questions. So we appreciate the chance for the dialogue, appreciate the chance to discuss these topics. So until next time, everyone, take care.